would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name's Robert Whitelaw, and I am the Rebel Broker. Licensed real estate broker in the state of California. Member of the National Association of Realtors. But please don't hold that against me. Make sure to take advantage of all the various ways to get in touch. The best is probably therebelbroker.com, where you can click on Contact the Rebel Broker and send along any messages you might like to see me receive. And I'll be happy to reply as soon as possible. If you'd like to become a member of the Rebel Underground, you can just text the word Rebel Broker to the number 44222. That's text the word Rebel Broker to the number 44222, and you will then become a member of the Rebel Underground. Finally, enter yourself into the drawing for a $50 Amazon gift card by heading over to therebelbroker.com, clicking the big red button at the top that says take the survey to support the show. Use the same email address both times you're asked. Answer a few questions, and you will be entered to win. We've already done our drawing for October. We're going to do another drawing for November, and everybody's eligible who enters. So feel free to take advantage of that. Nothing like winning $50. Going to take a little bit of a look at the marketplace today. We're trying to answer the question: does it make sense to invest in real estate with the idea of becoming a landlord today? Just based on the numbers that we're seeing now. There's numbers in that for all those homes that were purchased in 2016, they're taking a look at what the single-family rental market report says about the return on that rental and on those rental investments. And in light of other things we've talked about over the last week, I thought it'd be good to sort of review that as a topic. But we've got a variety of different stories we're going to sort of weave together here on that subject. And a lot of it's going to depend on what because remember, this isn't always a zero-sum equation. It's going to depend on where your skills lie too. Where are you best suited to make the most out of your investments? So if you're someone who's very comfortable, or if you're brand spanking new, maybe flipping makes more sense to you from the standpoint of what the market's currently doing versus what your skill set is. Maybe you're someone who's more minded in that direction. But if you're somebody who likes the buy and hold strategy, the then rent it out strategy, this may still make more sense, even though we are seeing a bit of a drop in the return based on things that are purchased right now. But then this also really reinforces something we've talked about on the show forever, which is you don't make your money when you sell your property. You make your money when you buy it. You need to buy it right. And that's so much of what we've talked about here in terms of the prep work you should do, the ground truth you should seek out, the numbers you should crunch, the things you should become aware of, the projections you should make. All of those things are going to help determine whether or not your investment in real estate is a success. And it all happens before you ever sign a single contract. So hopefully you've already got those kind of under your belt. You've already been listening to the show for a while and gotten a few of those skills as part of your toolbox. What we're going to do is talk about now, what are we seeing in terms of numbers moving forward? Excuse me. And try to figure out, is there a good timing here in terms of what sort of strategies you are going to use? And of course, we're talking about numbers that are sort of general across the country. You're going to need to take these same concepts and translate them into your local marketplace to determine whether or not it makes sense. Now, I want to start. Some of this is just ground truth in terms of what I've experienced. But one thing that I think is important to mention is something I've tried to mention at every opportunity, and that is so many of these headline communities where folks have really wanted to jump into the Silicon Valley marketplace or some of these other marketplaces that have been super hot. And just remind everyone that, yeah, sure, the property values there have gone high, and that's all great, but you can't go into a time machine and go back in time and take advantage of that. You have to look at where you are now and figure out where you're going to go. I've talked to folks who have purchased properties in 2016, and there is no way that they could, on a conventional purchase, that they could break even if they tried to rent the properties. It just isn't going to work out given how much they've been paying for these properties. And I'm sure that this particular phenomenon that we're seeing plays into that one big thing that's feeding this decrease in the amount of money that folks are making off of their rental properties is kind of feeding off of this. So many of these big name, very recognizable marketplaces have really kind of peaked and have not been places where I would suggest anyone purchase unless the math really, really works for them. And as I've mentioned before, I'm absolutely in the market. I've got searches running for various areas I'm interested in, and there's just nothing coming up. I think I mentioned yesterday I looked at 3 homes over the weekend, and it's getting to the point now where by simply driving 10 or 15 minutes further out and broadening my mushroom, remember we talked about that, where you find the areas where prices are crazy and you move outward from there to find the areas of opportunity. And at some point, you can feel where the sweet spot is in terms of, have I gone out too far? If there's even a slight downturn, is the area I'm in now simply going to get left out on the vine instead of continuing to enjoy some of the benefits of being close to these more expensive areas? Now, in the context of my area, I'd call Silicon Valley, the San Jose, Sunnyvale, Santa Clara, Los Gatos, Cupertino area is sort of the sweet spot for Morgan Hill. But if you go about another 10 or 15 minutes south, you're in Gilroy. And I think the magic line is somewhere in that range. It's Morgan Hill is obviously a better investment, but I'll tell you what, simply by driving another 10 minutes down the freeway and getting off, I can go to an area that I think has relatively long legs in terms of being able to, in other words, the last areas that I think would ever see a reduction in what folks are willing to pay in rent to live in those areas for $100,000 less than what I'd be paying in Morgan Hill, or for the same price that I'd be paying in Morgan Hill, I can get a property that's 100% ready to go. It's got the most recent updates. It's remodeled. It's move-in ready. It's perfect. In Morgan Hill, you pay that same amount of money for a property, and you've probably got another $100,000 to spend to make it like that property that's 10 minutes south. So and that's where sort of the math comes in terms of figuring these types of things out. And dynamics like this, where we're starting to see what could absolutely be a pivot point in the marketplace as it relates to what folks are able to get for rent, I think it's more important than ever to be aware of that. And I don't use the word pivot point lightly. I actually think you can sort of sense these as you go back through the market. You can find things that occur, not usually a singular thing, but usually several things overlapping that kind of make you feel like you've hit a turning point. Things are about to change. And given all the things we've talked about over the last week, and I think I mentioned this actually in an earlier show, I think we're there. I think that when we look back, we'll probably be able to recognize this as a turning point. I think the last big turning point that we identified on this show was when things went nuts about 2.5 years ago, and the markets literally went from being slow and buyers were in the driver's seat to sellers were in the driver's seat, and it happened within 1 quarter at the beginning of the year, and you could feel it before it actually came. So let's go ahead and jump in and talk about this first article that comes to us from Housing Wire, and they're actually quoting a study from Realty Track, and it's one that we've talked about before. It's the single-family rental returns have dropped to the lowest level in 9 years for homes purchased so far in 2016 among the 473 counties analyzed in the third quarter of 2016 single-family rental market report. So keep in mind, this is for homes purchased in 2016. So it's interesting to phrase it in those terms, because those are the folks who obviously most recently purchased and then decided to move into a rental environment, but their proceeds have obviously been dramatically hit. So, and that spells a slowing in the marketplace. They go on to say that the average annual gross rental yield, defined as the monthly rent, annualized, divided by the median home price, came in at 8.7% in the first 7 months of 2016. According to the report, this is down from 8.8% in 2015 and the lowest level since 2007's 7.3%. So not gigantic drops, but again, numbers that indicate something that I think feeds into this idea of a pivot point. We've talked about these other ones in terms of rental issues happening in New York and in San Francisco, where rents have sort of frozen. We've talked about how, at least in the Silicon Valley area, we've seen a dramatic increase in the number of homes that are going to enter the marketplace as rentals. We've had in 1 year a 75% increase in the number of those kinds of housing units, meaning rentals. But the proviso is these are the least desirable style of rentals. So, but from a cost standpoint, from the consumer public trying to decide, am I willing to spend a premium for a single-family residential home or a townhome or even a condo? Even some condos are better than apartments. That's really the fight that we're going to be getting into as soon as we start moving into an area where this becomes an issue. Okay. Now, they go on to state here that while average rental returns on properties purchased so far in 2016 are at a 9-year low, these returns are still attractive compared to alternative investing opportunities. So I think maybe that's also a part of the takeaway. It really depends on what you consider to be a reasonable return on your investment. And given all the other options that you potentially have, ranging in risk, and as part of your risk analysis, it's really important to take into account how much control you have. If there's one thing I've learned in this business is the more willing I am to take more control, the better my investment does for me. I think, and that's, that was a hard won lesson. Because I'm a team guy. I believe in bringing in people who absolutely add value to the real estate equation for me, and particularly with skills I simply don't have. If I want to invest in another area, I have to rely on finding good people on the ground to give me some insights. Now, can we suss some of that stuff out ourselves by driving areas and doing some online searching and those kinds of wonderful things? Well, we can get some leads by doing online searching, but you're not going to know for sure until you've really taken the time to drive those areas and really get to know them yourselves. But my point is that the level of control you have, the level of the persistence of the asset are things that I think about when I'm thinking about what I want to do with my money. And it's one reason why I am tending to move away from having any money in these retirement accounts that I've sustained for so long. And frankly, my investments over the last year have been the most expensive date ever, simply because most of them have lost money. And I think that we're heading for a scenario where there's a very good probability that they're going to lose money over the next year. One of the few things that has saved me is that I left a huge chunk of my 401k money in the form of cash and resisted all of the probing and pushing from my financial guy to put it into something. And my money has done better as a result of that, because the instruments that the other parts of my investments were in have done worse. And of course, the only control I have there is to decide whether it's in or not in, right? If everything completely dissolves, at least come the end of the day, if I'm in real estate, I have a piece of property. Now, granted, that's a fuzzy statement, right? How many of us really own our homes? If the bank holds a note, who really owns it, right? So that question comes into play. But at least you have an asset, you have a thing, and it's always going to be in demand to one degree or another. And that's where the trick is. It's in those degrees. A year ago, I was suggesting that for those of you who are doing this analysis, because we're anticipating a slowdown coming down the pike and assuming the local truth that you're getting from your own research is telling you the same thing, assume a lower level of return and assume that you are potentially going to have to take a hit on your rent. So, and that's the way I've been doing my math. I'm content. Now, my vacation place in Hawaii completely bucks trends right now. I am booked about 3 months ahead of time. It is still chugging along at warp speed. In fact, if I had to rate the performance I was getting this year versus the same time last year, and this is the first time I can do that. I've now, as of August of this year, I now have 1 year full-time rental stuff going on with that place. So I've got data that I can play with now, and we all know how much I love data. I'm doing way better than I was a year ago, and a year ago I was charging less for my daily rent on that unit. So I continue to watch it. I continue to see how things are going. But again, the reason, and even that investment, the reason that's making money is because I have taken much more of a front seat in managing it. And it brings home the old adage, no one cares more about your success than you do. So, and you have to assume every other person who's involved in the process is saying the same thing. So I guess the bit of advice I would draw from that is figure out how your success is directly tied to the success of someone else. So, and that's a difficult one to answer in some cases, but if you're talking about real estate agents, their success is linked to you making an investment in a piece of property. So you're going to have to hope that they are going to give you the best advice possible. And you're going to have to go with your gut on analyzing that. In a place like for property management, it's a different equation. In my situation, what I found was that the folks involved had far too many other dogs in the race that were competing against my dog. So when I cut myself away from that element, that part of the game, suddenly the property did fantastic, despite earlier attempts on the part of my family when other folks owned it to do the same thing, but they had completely delegated the property management to someone else. And the difference is huge. My family is a little bit stunned at how well the investment's doing, and we have some great chats about it. But the truths that I've shared with you from that experience, I think are applicable to an awful lot of things. Long-term investments, long-term rentals, a little bit less so, simply because you can absolutely play a bigger role in finding the tenant in that case, and then just delegate all the day-to-day management to a firm, to a property management firm. Okay, let's see. After a drop-off in single-family purchases by both individual institutional investors over the past 2 years, we're starting to see investor acquisition activity picking up again. Now, this is also reflected in a jump last month in the number of all-cash purchases, which is also weird because you'd think since we're sort of at a top here and it's starting to look like things are going to slow down, why would we see a jump in that number? And I'll be honest with you, I don't have a cute answer for that one. It's one of those things that sort of defies explanation for me, given what I'm seeing in these numbers. All right, we're going to go ahead and move on to another article here in just a second that comes to us from, again, Housing Wire, but comes relating to a statement made by Fannie Mae. We'll cover that in just a second, but for right now, we're going to take a break just for a minute, so don't go anywhere. We'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right, aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. We're sort of tying it all together here. We're trying to answer the question, is the market for landlords and rentals slowing? Are we starting to see a turn, a pivot point in the marketplace that could absolutely affect your bottom line coming in the next year? And it really depends on where you are. If you're someone who currently holds properties, it could absolutely play a part. But of course, if you're also someone who's looking to rent. This is all information that's good for you to have as well. Now, another article from Housing Wire, the headline is Fannie Mae, Economic Growth to Slow Down Remainder of 2016. They've actually revised their estimates from the last prediction down. So sort of dovetail that in with what we've already discussed. We're already starting to see returns on single-family rentals declining in 2016. The prices folks are paying in 2016 just are really closing the gap between cost of acquisition and return on that investment in terms of monthly income. Now, another thing that's interesting to note is there are some very big companies, conglomerate style, that own lots of single-family residential homes. Remember how so many of those were sold by the government at auction and required that they buy all of them in a block and did all of these things, which really kind of, frankly, left the playing field a little uneven for the little guy. You had to have millions and millions of dollars to come in and bid for a lot of these chunks of homes. So it basically made it impossible for a small local investor to, say, pick up a single home. They had to go and they had to bid and they had to jump through all these hoops that really only a super large conglomerate or corporation could satisfy. And I find that frustrating. For my money, and I mentioned this at the time, it would have been a much better move to simply do it on a website, have it be an eBay-style auction, and have anybody who wants to come and bid for each individual property. I think that in the end, the proceeds would have been higher, and I think the distribution of properties would have been better since it would have been in the hands of far more people rather than some of these super large corporations. Now, one thing that's also interesting to keep in mind is a lot of these businesses were not in this because they're real estate companies. A lot of these were simply investment firms or big companies with large amounts of money that simply wanted to increase their holdings in this area because they looked at it as an opportunity. It's going to be interesting to see how this plays out. I've always argued that as soon as the math no longer works for them, that they would liquidate these properties, or as soon as they see a peak where there's a potential downside coming, that they would tend to back away, that they would tend to liquidate and try to sell those properties. I haven't seen that happen yet in terms of news reports. I haven't seen sort of a en masse selling of some of these holdings by these large corporations that purchased so many. Now, remember, also, most of them are constrained to actually being forced to hold the property as a rental for 5 years before they're allowed to sell it. So we'll have to see how that plays into it. There are still properties outstanding. In fact, we're 10 years past the worst time. We're only about 5 or 6 years away from some of the last, and in fact, not even that long ago, where some of these auctions were taking place, where these big businesses were buying these big chunks of defunct loans and foreclosed properties. So it'll be interesting to see how that plays out. That would be interesting to see because I suspect that would be an interesting move in terms of changing single-family residential homes that are rented. The rental market would be impacted by seeing a dramatic reduction in single-family residential homes. Okay. Now, Fannie Mae expects economic growth to average 2.4% in the second half of 2016. And while this is up from the 1.1% for the first half of the year, it's a slower pace than what Fannie had previously forecasted. So blend that with what we've already talked about. We're seeing what looks like a weakening in the rental market in terms of investment versus reward. We're starting to see a rental market across the country hit in terms of areas like San Francisco, Seattle, New York, where we're starting to see the rental market take a 20% dive in New York. Mix that with now Fannie Mae, who is loath to ever say anything bad about what's going to happen in the marketplace, now having to readjust their expectations for the year downward. I think that's another little signpost that could inform us that we might be looking for more of a slowdown that moves on in the next year. Now, they do go on to say that existing home sales, new home sales, single-family housing starts, and single-family construction spending declined in August. In addition, pending home sales and purchase mortgage applications weakened during the month, suggesting continued weakness in existing home sales in the near term amid very lean supply. And next, and this one's from CNBC, real estate remains the go-to asset class for the ultra-rich. Now, this one I throw in because it's a little bit surprising to me. It dovetails in with the fact that we've seen upswings in the amount of all cash transactions. because we saw it declining for so long. So clearly what we've got here is perhaps a different class of all cash buyer. It's less the investor, and it's more the ultra rich person who isn't necessarily a real estate investor. A survey by Tiger 21, whose 400 members count a collective $40 billion in assets under management between them, shows a 28% average allocation to real estate investments and a 21% slice of the portfolio being allocated towards private equity. So already you start to get a feel for what this is. This is not as much we are a real estate firm doing real estate investing. This is very similar to what we talked about before relating to companies that simply got into the real estate business because it was so cheap that they could buy it cheaply from the FHA or from the government at auction. I think that this trend, this increase in all cash purchases, the quote unquote ultra rich jumping back in and sort of breathing new breath into this idea of all cash purchases, I honestly believe that this is a transition from conventional investing in the marketplaces where they would invest in company A, B, or C based on whatever information they have. And I think that they're moving it in the same way that they would move their money into gold or silver or anything else. I think they're moving this into real estate based on the assumption that it's going to perform better than their other investments. So I don't think it has a great deal to do with necessarily folks thinking, I'm going to jump in and be in the real estate market. In fact, I think this money that's being used, the folks who actually own that money, the folks that are totally hands off of this. I'm willing to bet this is simply investment strategy that stands independent of the typical real estate investor mentality. Let's see. According to this article, quote, most of our members, this is the Tiger 21 thing. Is that what it's called? Tiger 21? Is that what I said? Yeah, Tiger 21. Most of our members are wealth creators, first-generation entrepreneurs, so they made their money building small businesses into large businesses. When they sell it, their natural inclination is to roll up their shirt sleeves and invest in another small business because they have the expertise and tolerance to do that. If you had built a printing business as an entrepreneur, you might be now an investor in a digital printing business. Everybody has some expertise, and if they can lever their individual expertise into their investments, they can really create an edge. In a suboptimal climate for billionaire wealth expansion, the poor performance. This is the part I like. The poor performance of hedge funds over the past year has caused an acceleration in client money deserting some managers. So that's what I think this is. I've talked already about, and I'm not some big player in the investment world. I'm someone who knows the company where my 401k is, but I'm not very hands-on with it. I stick it into a fund and I let it sit there, and I see what happens in the statements that I get from time to time. These folks are simply reading the same writing on the wall I did. And so with their billions of dollars or millions of dollars, they're moving it into real estate, which is on a much, much smaller scale the instinct I've come up with in terms of what I want to do with my investment money. Now, granted, mine's tied to a for instance, let me clarify a little bit. As I've mentioned, I have a lot of money in 401k stuff, and there's a penalty if I withdraw that money before I'm 59 and a half. The only thing I would have already spent that money on real estate if it weren't for that 59 and a half year old thing. And I would have liquidated all that I've got and put that into real estate. I would have done that probably 2 years ago. So I think this is the trend we're seeing. So it's not so much that anyone can say, wow, the investors have come back. And I mentioned that earlier only because you're going to see that headline. Investors are back. People are expecting the markets to really go crazy, but it's not that. What it is a dynamic of preserving the money that they've got. So instead of putting it into an investment portfolio, like they mentioned here, where they're going to lose money over a course of another year, they want to put it into something where they think they're going to make some level of money, whether if just holding it and then they enjoy the appreciation of the property, or whether they buy it and hand it off to a property management company that'll take care of it for them. It's the exact same move that folks make when it comes to trying to figure out what they're going to do with their money. But I don't think this is the quote unquote real estate investor mentality that is pushing this because the investment element is so great. I actually, and the reason why I want to portray this way is because I actually think this is more of a panic move. This isn't a confidence move. This is investors saying, all of these other investments that I've held in these huge institutions with these managers who I pay tons of money to manage this money, I don't believe it's going to make money there anymore. Now let that sink in for a second. Because now what you have to do is kind of come to grips with all the other things we've talked about relating to the larger economy and what likely effects it might have on real estate if things go south. We've talked about Deutsche Bank, how leveraged they are. They only have 3% cash and they've got trillions of dollars in derivatives. And we're going to have to do another show on credit default swaps because those things are back. For those of you who've been listening for a really long time, we talked about credit default swaps way back when this thing went nuts last time in terms of pinning down reasons why everything went horrible. Credit default swaps are when you bet things are going to go wrong. And we're seeing that return again. So if you want to Google it, feel free. That's more nightmare fuel for you if you ever find yourself preoccupied with economic things before you go to bed. But I think this is another thing that should concern us in terms of our faith in the overall market moving forward. Because if these folks with all the big money are thinking the smartest move is to pull it out and put in something physical like real estate, well, then maybe the rest of us need to be a little bit more worried. Remember, we've also got B of A saying that stock market crash, all these other things, talking about them being imminent. It's been more than just B of A now. We've talked about how B of A came out with that. There was actually, I can't remember who it was. I don't know if it was FHA or Fannie or Freddie, but it was one of those who talked about an imminent downturn. All things that should scare us. So again, at this point, does this mean we step back? We say we're done with real estate? No, I don't think that's what it means. I think we continue to do our math. We make sure to give ourselves margins that make sense. And in the long term, you're going to do a lot better. And that's what I'm doing. That's what I encourage folks who I talk to do. But again, keep emotions out of it. Do your math. Figure out what the projections are for you in your local area. Get that ground truth and keep pushing forward. All right, folks. As always, I truly appreciate you being willing to spend your valuable time listening to me for a little chunk of each day. I hope that what I provide in terms of information or things to think about or maybe some good tips and tricks to move forward in real estate make it worth it for you. Thanks again for listening. I'll talk to y'all next time.